Hey, it's Rav. Welcome to Everyday Investor, the hottest investment show in the world. That's right. I said it. I don't care who knows it. Remember, this show is all about helping us grow our money. The challenge often is we take our precious time, we go to work, we get a paycheck, and then we buy food, which is a good thing. We need to eat. But we take our time, we go to work, we make money to provide. Imagine a life where money could make you money, where you could work a little less if you wanted to, and then you had time for the things that mattered most to you, spending it with family, friends, engaging in a purpose that's greater than yourself. That is the essence of this show. Remember, whenever you're offered any type of investment opportunity, always ask 4 questions to start. 1, what is the return on investment? 2, when do I get that return along with the money that I put in? 3, what is the minimum investment amount needed? And 4, what is the risk? Super excited about today's show. We're going to be talking about, wait for it, we'll be right back. Coming up, we're going to be talking to my good friend Amanda, where she teaches us the buy and hold strategy with a partner and a refinance.
I put in all of the work, my partner puts in all of the money, and we share the investment 50-50. So right now, that is current state. But back in the day, until I met Rav Toor, I was putting a little bit of money into my deals.
The mortgage world has changed. Has your advice? Are you looking for a modern approach to your mortgage planning process? Advice tailored to your unique, ever-changing circumstances? Whether you're upsizing, downsizing, purchasing, or refinancing, the Kyle Ford Mortgage team works with individuals and companies to custom tailor the right mortgage product for you. Working with a wide selection of lenders, we're here to serve our clients and help them achieve their real estate and retirement goals. Contact the Kyle Ford Mortgage team today, Canada's mortgage choice.
Hey, it's Rav. Welcome back to Everyday Investor. Before we talk to Amanda, let's go to our stocks expert, Omar Khan. Over to you, Omar.
Thanks, Rav. Omar Khan here, guys, with Data Trading, with the weekly market review. The markets are at all-time highs. We had positive markets on the Dow, on the S&P 500, and the NASDAQ. But what is happening is, if you've guys ever heard of this term called something like sell in May and go away. All right. So the stock market has a bit of seasonality to it. It does really well from October to May, and then statistically from May to October, not as well. We're about to approach that period. So with the markets being at all-time highs, and now this fear of the treasury yield going up, thus inflation, the markets keep pushing all-time highs, but the market looks like it's getting a bit tired. And that would coincide very well with the end of this seasonally strong period of time. So it looks like we're hitting a bit of a top-end range here, but let's see what happens. What's really going to determine how things move forward is the quality of the corporate earnings coming up. And then essentially at the end of the day, that's what always moves markets up in the long run. So let's reevaluate and see how the markets do after some of these earnings start coming in. But I think they're going to be quite robust, and the markets will move forward. But in the summer months, the market doesn't tend to do as well. So we'll really see how these corporate earnings come in. I'm quite optimistic that they're going to be pretty good. And then let's see how the stock market reacts to it from there.
Thanks, Omar. Always great to hear from you. Chat next week. Amanda, thanks for being on the show with me.
Hey there, Rav. Thanks for having me on.
Yes, look at you, full of energy, but you're not as lean and slim as you usually are. And I wouldn't know that by looking at you, but you told me you've got a little something in the oven, 7 months now.
Yeah, I can't believe that you're starting with this, but yes, you're right. I am more than 7 months pregnant right now, so not the same body shape I'm used to, but we're thrilled about our new little bundle on the way.
Well, you look great, and why wouldn't I start with that? We want to start with the most important things in life, and so very, very excited for you, Amanda. Congratulations. I'm sure you're going to teach him or her, we don't know yet, Rav or Ravina, they both work. It's all good. But you're going to teach them real estate investing. You're going to teach them property management. You're going to teach them, all these types of things, because you've been doing this a long time. Not only have you been doing it for a long time, you're also a coach with a big outfit, Keyspire. And so how's that been going?
Yeah, it's amazing. Actually, I've been with Keyspire for it'll be 7 years this year. So I absolutely love what I get to do at Keyspire, run the coaching team, and get to interact with our students and teach real estate all day, every day. And actually, just recently brought my husband on board to the coaching team as well. So we'll both be doing the same gig.
That's great. Your husband's joining you as well. That's got to be a lot of fun.
Yeah, it's going to be.
Nice, nice. So we're going to talk about just a buy and hold strategy, but you often use other people's money. You have a partner. I know you and your husband do a lot of the work. You're experts in it, but you often get money from other people like Rav, perhaps, who want to be strictly passive. And then you like to refinance, as you call it, flip to yourself. So let's talk a little bit about this strategy. Where is the one that we're going to look at here in a few minutes? Where does this one take place?
Yeah, so this one is in Guelph, Ontario for this specific case study that I've prepared for today's show.
Okay, nice. And you tell me about why you like to hold the properties as opposed to, doing what you do and then exiting with a sale and then maybe doing it with a different property. What's the reason that Amanda likes to do that?
Well, I think number one reason is going to be the passive appreciation. So we've got that long-term growth of holding real estate in our portfolio. And where I am at a point in my life right now, so I'm in my mid-30s right now, so I'm still looking to accumulate real estate, and I don't want to retire out of a portfolio for a number of years.
And does your, because again, you're a veteran coach at Keyspire, so that helps you eat and provide, especially for the little munchkin on the way. But does your portfolio provide you enough cash flow, or are you really banking on someone paying down your mortgage and that passive appreciation, or is it a combination of all?
I would say it's all the above. So I've been investing in real estate since 2006. So we try to just accumulate and build properties into our portfolio. If I had it my way, I would never sell a property again for the rest of my career. And yeah, that definitely allows us to build that passive appreciation, but of course, cash flow. Cash flow is king. Of course, we want to make sure that we're getting that monthly income that's coming in each and every month.
Yeah, because I appreciate that, you sharing that, and there's many others that share the same sentiment. And then there's others that would say, yeah, you know what, I'm now going to dump my properties, pay the capital gains, but now my net worth might be, $2 million. And now I can lend that money to Amanda at 8-10%. And so on my 2 million, I'm still making my 160,000 to 200,000 a year. So I guess different people for, where they're at in life. Maybe you're in your mid 30s. Maybe later in life you might, or maybe you won't. Maybe you're just gonna. And the other thing I think that people need to know about you is you are a property manager. So you enjoy, it's not for you to have, 100 tenants wouldn't be a big deal because you know how to properly manage. Do you find that there's a lot of people that just don't want to do that?
Yeah, I do. So part of what we offer for our, financial partners or silent partners is that we offer them property level returns from a completely passive position. So what I found over the years is most people do not want to do property management. They do not want to manage their tenants in-house. Yeah, you included. And I can't really say that I like it. That might be a bit of an overstatement, but I understand the business and I know how to run it effectively. So this is part of the value that I do offer to my partners. And sure, long down the road, there might be a scenario where, we do want to be completely hands off. But right now we find, Marty and I find that we are able to manage our portfolio, manage these properties for our partners. And it is still very worth our ROI that we get from each of these investments. That 8 to 12% does not get me excited at this point in my career. I definitely want to see double, maybe even triple digits. And I mean, if I'm not putting money into the deal at all, then we know how this math works and it's an infinite return.
Yeah, no, no, no. And like I said, there's no right or wrong. I've got friends that have, close to 100 single family homes, single family, like, 100 different tenants. And I'm not talking like they're in an apartment building. They're single family, 3 bedroom, 2 bathroom, and they just love doing that and they never want to sell. And then I have others that, comes a time in their life where they just want to sell everything, give their money to Amanda, and enjoy the 8, 9, 10%, whatever that return is. Okay, so let's start with this case study. So we have a property here, and you said this is in Guelph.
Yep.
And where are you living right now?
So I'm just outside of Guelph, so nearby, about 15, 20 minutes from that city.
And you are not doing deals just because they're conveniently located close to your house. You're doing deals where the numbers make sense, yes?
Yes, but I so happen to only invest in the city of Guelph. I mean, luck of the draw. I'm born and raised. I'm a Guelphite, is what us Guelph people call ourselves. And this just happens to be one of the best cities in Canada to invest. So I have not needed to go elsewhere because the returns are absolutely the best. And it's super convenient for me to do that in-house property management as well.
That's fantastic. Okay, so let's go slowly through this. So what did we do?
So I found a partner first, and they said, hey, listen, we're interested in doing a joint venture, is what we call it, with you and Marty. These are our goals. This is our budget. Are you guys interested in building a business relationship?
And generally speaking, for you, is it generally a 50-50 kind of split where Rav is the money to Amanda and Marty? Marty and Amanda do all the work, and then we split the profits 50-50. We talk about how that works, whether it's in 5 years or whether it's through the refinance. Is that kind of like, walk me through that in generally?
Yeah, in general. Actually, Rav, I'm not sure if you remember this conversation that you had with me in about 2014. It was when you and I had first met, actually. And you had a massive impact on my investing strategy. I recall telling you how clever I thought I was getting into these joint venture relationships. And at that time, I was actually splitting the down payment with my potential partners. So I said, hey, Rav, I put in 10%. I get my partners to put in 10%. And then we do all the work and maintain a 50% equity. And I remember you just looked at me and you said, well, why are you putting in any money at all? And I didn't have a good answer for you because I was putting in all the work as well. And my concern at that time was I thought people would say no. So I was trying to really sweeten the deal, but I was really sweetening the deal more than I needed to. And it was my very next joint venture that I did that I actually presented the 50-50 split as you just described, where I put in all of the work, my partner puts in all of the money, and we share the investment 50-50. So right now, that is current state. But back in the day, until I met Rav Toor, I was putting a little bit of money into my deals.
Well, listen, I've been blessed to have many, many, many conversations with you. And I don't remember that one, but great. You're welcome.
It was a monumental point. So thank you again for that, Rav. It stuck with me.
So we bought this in Guelph. We have a joint venture relationship, which just really means a partnership. You guys are the experts in doing all of the work, or even, being over the work. It doesn't mean that you have to do the actual work yourself, but you're over all that. And then Rav might have a few dollars sitting in the bank. Now, what happens if it's registered? Can you use registered funds as well? If I had RSPs or RESPs or TFSA, or no, it's typically just cash?
It's just going to be cash for one of my deals. So I'm looking for my partner to fund the down payment and to hold title on the property and qualify and hold the mortgage as well.
Fantastic. Okay. So then what's next? So so what you're saying is Rav and Amanda Marty team came together even before we had a property, or did the property come first?
The partnership came first.
Partnership comes first.
Yeah, you got it. So then the next step is that I went out and found a property that is suitable to my partner's budget and their investing goals, and of course fits within the parameters of mine and Marty's expertise. So then I go and get a property under contract and then come back to you and say, Rav, this is the deal. Are we ready to lock it in?
Okay, so how much did we buy this property for?
$575,000.
575 was the purchase price. And are we doing a major renovation on this, or do you like to do general turnkey properties?
So for this property, there was a substantial renovation required. So my favorite strategy is to create that secondary suite. So for 575, we bought a single family bungalow. And our plan for 95,000 for the renovation, I might be jumping ahead, but 95,000 for the renovation, we actually created a secondary suite, which was a legal basement apartment.
Okay, so the reno was 95K?
Correct.
And then the down payment plus closing cost was what?
So the down payment was 115,000 and closing costs were about 10,000.
So I'll just put 125 here. So down payment plus closing. Okay, let's take a quick break, Amanda, and then we'll go continue with the numbers and get to the annualized return on investment. We're talking to my good friend, Amanda. She is a veteran investor as well as a coach trainer. Don't go anywhere. We'll be right back.
At Theta Training, our goal is to help you achieve financial freedom by teaching you the foundations of trading stock options. Join our growing community. Learn through our live-streamed weekend course, or develop your skills at your own pace online. Understand how the stock market works and how you can use the options market to earn additional income. Achieve financial freedom and live life on your terms. Let us help you build your empire.
Hey, it's Rav. Welcome back to Everyday Investor. We're learning from my good friend Amanda. Before we continue with the numbers, let's go to our mortgage expert, Kyle Ford. Over to you, Kyle.
Thanks, Rav. This week I want to talk about secondary home financing. As the pandemic moves forward, many Canadians are reevaluating where it is they want to live. Though most people aren't prepared to sell their home in their urban center that's close to their current office, they're taking that vacation money that they had and reallocating it towards a vacation home or secondary residence. Did you know that you can buy a secondary residence with as little as 5% down? Not every lender offers this program, and we need to get an insurer on board. Genworth is the primary insurer for this program. However, it is an option, and it's a way for you to get into that secondary residence with a very small down payment. Feel free to reach out if you have any questions on this program, and back to you, Raf.
Kyle, always great to chat. We'll talk to you next week. So Amanda, we are looking at some numbers here. You bought a property in Guelph with a partnership, and that partner put in $125,000. That's the down payment plus closing costs. Plus they put the money in to reno this. You bought it for $575,000. If I add these two numbers up, I'm getting $220,000.
Yep, you got it.
Okay, so Rav had to break his daughter's piggy bank and just to get enough money to put that in there. So I put in the $220,000. I go on title, but Amanda is going to help Rav feed his kids. How are we doing this now? So we're in for $220,000 on the deal, and the property is we purchased it at $575,000.
So what's next now is we create that secondary suite, and we actually improve the total value of this income property, and we tenant the property as well. So we want to do that before we refinance so that we can prove that this is now an income producing property. And originally, this is really fun because I bought this property in November 2020. We're actually just finishing the renovation right now. So it's a very current, fresh deal. And originally, I had projected the ARV, the after repair value, to come in at $725,000, which is a pretty healthy ARV.
Yeah.
Well, turns out the market is just exploding right now. Super hot market. This is no secret to anybody. The
Yeah.
ARV is coming in about 900,000 right now, Rav.
Wow. We bought this property at
575.
575K. We put in 220. That's closing costs and the renos. And you're saying this property is now worth what?
900,000.
And I can't convince you to flip yet.
No, but instead, what we're going to do is a refinance of the property. So this is where my partner gets to recuperate some of those initial costs before we roll into the hold period. So the way I structure my deal is that we do a refinance and they will recuperate their renovation costs and their closing costs, and if there was any carrying costs during the project. So they get to pull that money back out, and they keep their initial 20% down payment in the deal until we actually exit the deal. So this leaves us with a fantastic cash flowing property for at least 5 years.
Okay, so the 20% that I put down was what on the 575?
Yeah, so that was 115,000. So that remains in the deal.
That remains in the deal, and then the 95K you're going to give me back from the refinance.
Yeah, the 95 and then plus 10,000. I think we said was for closing costs as well.
Okay.
And anything else that came out of your pocket except for that 20% down payment.
Okay, so that's fantastic. So now I only had to put 20% down on a $575,000 property. I got my closing costs back. I got my renovation costs back, and you lifted the property, you and Marty, by doing what you guys do.
Yes.
Then in 5 years, what are we going to do?
So in 5 years, we keep it open-ended. So this is where we reevaluate the relationship and say, Rav, do you want to buy me out? Or you might say, Amanda, I want to leave this deal. You buy me out is an option. Or we can do another refinance on the property and share an equity pull. Okay, so remember, we're going to pay that mortgage down over all these years. It's going to continue to appreciate as well. So we could do a refinance and pull some equity, or we can just renew the mortgage, not pull any equity, continue to pay that down as well and experience that cash flow and again, ongoing appreciation. Or another option is we put it on the market and sell it for top dollar. And then you would recuperate your 20% that you initially put into the deal first. And then we would divide our profits 50-50.
And you know, you can do this all day long. I mean, you've been doing this this strategy. Tell me what generally, conservatively, what's the ROI on something like this on an annualized basis? I know it's hard to tell because in the first year, obviously it's insane. But if you look at it over the 5 years, without us splitting it, what would you say is the return on investment?
Yeah, great question. So total conservative ROI that you can safely project for this project, this type of project. And what I did project to my partner initially back in the fall was about 47% total ROI on this property. But remember, we're going to split that 50-50. So they were going to get 23.5% annualized return on their investment.
So you said what? The ROI was going to be 47?
Yes.
47% on an annualized basis, but we're splitting that. And so 23.5%, and that's split. And you're saying that's 23.5% every year over the 5 years is what you projected.
Yeah, you got it. So that's what you would be getting as the financial partner on your investment.
Yeah. So Rav gets that, and then you get your own. And so what do you After the 5 years, yeah, I love that there's so many options. I buy out, you buy me out. We continue for another 5, we sell it. There's many options. And how much work, and I assume a lot, how much goes into at the beginning so that there's no confusion? I mean, is there kind of, back in my day when I was doing things, we just do it on a napkin. I'm sure that wasn't the wisest. Do you have the documents all set out, Amanda? And is it, really overly complicated, or is it, simple but thorough? Talk to me about that. Like when Rav wants to JV partner with Marty and Amanda.
Yeah, great question. So back in the day, I definitely had some napkin agreements as well. And thankfully, everything turned out just fine. I've got great relationships. I've, evolved and developed in my business practices over the years right now. And I like this a simple approach to these joint venture relationships. So I've got everything prepared and ready to go. So I like to walk my partners through step by step and show them the way, essentially, and say, hey, if you're interested in this deal, I've got a process in place, ready to go. And I keep them on track every single step along the way. So there's a little bit of work with the relationship part when we're just getting started. But once this property is up and running, it is smooth sailing and we're doing all the work.
And other than wanting to, check in on you to see how the bun in the oven's doing, when it comes to business, how often are we talking? I mean, is it really, because I'm sure you don't want to work with somebody that wants to call you 5 times a day, but are we talking every few months just to see what's up, or how does it work?
So I like to look at this as kind of like a doctor call. No news is good news. Is definitely a principle that I like to work by. Certainly an annual conversation to say, here's your annualized reports. This is how the property is performing. But I have different partners who are interested in different communication styles. So we actually put a threshold within our joint venture agreement to say, hey, if there's something that is more than X amount of dollars that's required for the property, just reach out to me and let me know what's going on. Otherwise, I've got, authority and full reign to just continue to manage the property as required. But what I find is that a lot of partners at the beginning say, yeah, I want to talk quarterly or whatever it is that they think is going to be comfortable for them. And what they find is they're busy with their day-to-day life. They don't want to talk about this stuff, and they can peek in on the bank account and see that we're performing well and everything is A-okay.
Love it. And are you actively always looking for different opportunities? I mean, is there an end here? Does Amanda want to stop at, 50 partners, 100 partners, 200 partners, or are you just going to keep going?
It's a great question. So currently, we are definitely looking for more joint venture partners, people who are interested in being financial partners, investing from a passive position with our investing strategy in mind. So I want somebody who is willing to hand over the reins and say, you guys are the experts. Can you take care of this real estate deal for us? Then yes, absolutely. We're accepting new partners. If I end up in a surplus that I've got more partners than investments, then I'll figure something out and we can definitely make that happen.
Yeah, no, it's great. Listen, Amanda, love having you on the show. When it's a good show, time flies. And so really we are out of time, but just 15, 20 seconds, just kind of your final thoughts on partnerships, passive investing, or whatever you want.
Well, I want to thank you for having me on the show here and the opportunity to talk about our strategy and some really great returns that we're able to produce for our partners as well. I love real estate. I could talk this stuff all day, every day. So, I mean, people are welcome to reach out and connect with me if they're interested.
Love it. And I love having you on the show. Like I said, we have, or you said, we both said, we have a relationship. And it's great when you can blend trust and competency together. And so I really appreciate that you're trustworthy and you are competent along with Marty. So thank you, Amanda, so much for being on the show.
Amazing. Thank you, Rav.
Yes. And thank you for watching. Without you, we would not have a show. Make sure you tune in next week. Same place, same time. Honey, I love you. I'll be home soon. Bye, everyone.